So you don't think you need to know about options, huh? Oh, what's that? You think they're too risky? Odds are you probably already have options and you don't even know it. Do you have a car with insurance? Do you have health insurance? Well, keep watching and let's connect the dots together. In this video, you'll get an intro as to what options are. Second, why would someone want to buy them? Or why would someone want to sell them? And probably the most fun part, constructing the payoff and profit diagrams, which you'll be able to download following a link in the comments. What are options? I first want you to think of derivatives. The world of derivatives is a big one. Think of that word derivative for a second. What does that mean? In a financial sense, a derivative derives its value from some underlying asset or product. Options are a type of derivative. Clear as dirt? An options contract allows the buyer to buy or sell an underlying asset at a predefined price known as the strike price at or before a certain date in the future or expiration date. In order to receive this option, the option buyer pays a premium at the initiation of the contract to the option seller. Calls. This gives the buyer the option, but not the obligation, to buy at the strike price at or before the designated expiration date, which is some predefined date in the future. For those that like actual formulas, at expiration, the profit of a call option is as follows. You can see that someone owning this option would see benefits if the price of the underlying went up above the strike price and enough to pay back the money they spent on the premium. A put contract, on the other hand, gives the buyer the option, but once again, not the obligation, to sell at the strike price at or before the designated expiration date. Here, the formula looks like this, and you can see the owner of this would see benefits if the underlying price went below the strike price and low enough to offset the amount paid in premium. Maybe someone is looking to make some big cash by placing a bet, either by buying calls or puts, that would have to move up or down in price by a large percentage in a short amount of time. I give to you the speculator. So who are the people on the other side of the transaction? They are people that can assume the risk that the buyer is seeking and see the premium, a fair amount to accept for that risk transfer. Another way to utilize options is for insurance. Take a position you currently have and want to mitigate against a catastrophe. This could be like car insurance, but for your stocks. And if you're afraid of chicken prices going up because you love them tendies, maybe buy some calls that will increase in value and offset all of the extra money you're spending on them tendies. With insurance, one is trying to totally transfer a risk. Now let's get to the good stuff, shall we? How to see the payoffs and the profits. Putting this into practice. We're now in March of 2022. I'm going to search PLTR for Palantir. This is a company. The current price is $11.34. I'll say we think it'll be higher and want to investigate call options. Let's start by analyzing a call option with a strike price of $12 expiring in April 2022. Now I'm on Yahoo Finance, but there are many trading platforms where you'd also be able to see the options chain. If you click that options button, you'll see the options chain. So here's the options chain. You can see the calls on the left and puts on the right. Notice each row corresponds to a different strike price. As the strike price goes up, you'll see the price of buying a call goes down and the price of buying a put goes up. Another thing to note is that these prices are listed as a per share amount, but each options contract is bought and sold in blocks of 100 shares. So if we go down to the $12 strikes and left to see the calls, we see 80 cents. That means it would cost us 100 times 80 cents or $80 to purchase this call contract. So let's visualize the payoff of this call option contract. Here you can see that below $12, the option is worthless. Why? Well, if you had the option to buy at $12, but the stock was trading for $5, would you still want to pay $12 per share? No, you just pay $5 per share in the current market. But how about our bottom line profit on this contract? Here, you'll see our former payoff blue line and our profit orange line, which is shifted down by $80. Now, why $80? The $80 shift down is because that's what it cost us to enter this option contract. So we see that $12 and below, we are losing our $80 premium. But as it moves up, we start gaining dollars to offset the premium we spent. At $12.80 per share, we break even as we recoup our premium cost. Everything above $12.80 is just gravy. Jack, this seems kind of complicated. Can't I just go buy the stock? After learning some of these basics, you may want to go buy the stock, but buying and selling options can be a useful tool in certain scenarios. There's a great saying in the Book of Five Rings, never become too fond of any one weapon. Now let's compare to buying 100 shares of stock. Since each options contract is for the option on 100 shares of stock, let's compare it to buying 100 shares of PLTR. Here we have our $12 call in blue and buying 100 shares of PLTR in gold. You see that at very high stock values, purchasing the stock profits better on an absolute basis, but we also had to pay a lot more money and we have more at risk. To buy the 100 shares of PLTR outright, we needed to spend $1,134, whereas the call option only cost us $80. One always should be thinking about the worst case scenario and understanding how much is at risk. Here you can see various stock prices at the expiration date, showing what you saw in the graph on the prior slide in table form. I'd like to shift your focus on the return on initial investment lines between the calls and buying 100 shares. You can see on a percentage basis, one isn't losing as much owning the stock when it's $12 or below in this table, except in the case where the stock goes all the way to zero. Once again, the call premium is all lost if the stock doesn't get up to the strike price. One of the things that is so appealing about options is the amplified returns they can provide in favorable scenarios, which you can see as the stock is higher at expiration. Welcome to leverage. On a dollar basis, owning the stock is more favorable, but not by much. And the return is amplified because to get the call, we only had to pay $80 instead of $1,134 to get 100 shares of stock. So let's explore the other fundamental building block of options, the put option. Let's go back to our Yahoo Finance option chain and explore the $11 puts. This is saying that at or before the expiration date, we would be able to sell each share for $11 each. This would cost us $95 per contract. Remember, this 95 cents we see in this table is per share, and each contract is for 100 shares. Maybe for practice, you can pause this video and graph what you think the put profit diagram will look like. I'm going to plot our 100 shares of PLTR again with the put profit diagram in green. You can see the put doesn't start benefiting until the stock falls below our strike price of $11. That's because even though the stock is falling, we can still sell each share for $11. Let's say you actually owned 100 shares of PLTR and then had bought this put contract. The effects of the shares and the put would offset each other at the lower prices to produce a profit diagram like this. What you've done is effectively purchased insurance on your 100 shares of PLTR. As now, when the stock drops to 11 or below, the insurance that you've bought in the form of the put kicks in. While owning a call and owning the stock benefit from increases in price of the stock, the put benefits from a decline in price in the underlying. You can see in the table form how this operates like insurance for someone that has the stock already. I hope this has been beneficial and a great intro course for you. All these strategies can be formed basically from calls and puts, and I hope you will explore more in your options journey.